on Tuesday, September 6th, 2016. Another awesome day to be a currency trader. It was a holiday in the United States and Canada yesterday, maybe a couple other places around the world, who knows. It was Union Day, Socialist Pig Dog Day. But whatever, you get a Monday off, right? Great, which means we have a shortened week and we got a lot of news going on today, and specifically, very importantly, today we have ISM services on a Tuesday. It's very strange. But after non-farm payrolls recently, we really need to dive into that info. So, without a further ado, let's play the happy song, get our trades on, huh? Kick busted. Yeah, let the awesomeness pour all over your body. Life is good, life is beautiful. So g'day, mate. Let me remind you that trading is risky, not appropriate for everyone. Your past performance is not indicative of future results. If I were me, I would suggest to you, you should stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. By the way, my name is Wayne. I'm the Chief FX Market Strategist for TradersWay.com. Thank you for being a client. We appreciate it. And we hope you're happy with the service we provide you. Now, Master Pip started his live account. Whoop, whoop. Welcome, buddy. Oh, didn't I upload it, Ronnie? Sorry, buddy. Hey, we do these sessions 7:30 in the morning every single day, Monday through Thursday, here at Forex.Today, and every Friday at FX Street for premium members. El Primo. I'm also Forex Speaker of the Year for the year of 2016 at FX Street. So, cool. So let's get to the charts. One thing I'd like to do today is go through the calendar, so let's do that if you don't mind. Hopefully you can see that. And I got it set on this week. Let me get my drawing tool going. Okay. And obviously when you look at this calendar, what you want to do is look for the highest ones first. But you know, another interesting thing is if you see a calendar that has a lot of medium, what it means is there's always a reason to be trading. Like the market should be fluid. It shouldn't be too choppy. It shouldn't be illiquid. Okay, it should be alive. And that's nice. And then, of course, the red zones, or the ones that are highlighted as being high volatility, that's when the markets can jump. But I think the bigger concern as a trader is that during the week the markets actually move, right? Remember the stock market went through something like 45 days in a row with an up or down day less than 1%. That's tight. So we want some fluid markets. Okay. So we're already out here, huh? Very nice. So very nice. So we're already out here. Did you trade the Aussie news? Yeah, as you know, I'm already long, so it didn't bother me. So Australian dollar spiked up. Yay! The only comment I have to have about that is it spiked up off the 4-hour 21. But of course, that's why we use a 21 EMA. It did its job. It did exactly what it was supposed to do. And then if you look at the hourly Stokes, just golden, just beautiful. But whatever. If you're already long, it's all moot. All right. So we're out here. The next big thing already is ISM services, otherwise known as ISM non-manufacturing. That's here today. And the interesting thing about this is the United States is a service sector. It is a service economy. And this usually comes out before NFP or the same day as NFP. It's kind of strange to have it on the Tuesday after NFP. And NFP was okay. Now, one thing I forgot, I was thinking about it over the weekend. If you attended that event, and I think about 600 or 700 people did, I think I went through the methodology, and the market expected 180, right? Didn't I go through the methodology? And then I'm like, it's going to come out like 150 according to this, according to the methodology, according to the model. But, then I said, everyone wants it to be well above 200. Right? Didn't I do it? Yeah, and a couple of people said, yeah, I did. I'm like, it came out 151. Oops. But I didn't even realize it until after. I didn't even bring it up in the webinar, but I was just kind of pondering the day as I always do, and pondering the week as I always do, reviewing in my mind. And I'm like, oh, snap. I think actually I did pretty good on that number. Yeah. Not spot on. Close. Very close. Brooke says he was there too, right on. So anyways, lucky dogs, but whatever. Doesn't matter. So anyways, we had an okay, slightly disappointing, but not horrific NFP. But we had a very disappointing ISM manufacturing. So we're like, a disappointment mixed in with some mediocrity doesn't make you feel good, right? But the news that we actually want here is the services. Okay. So wouldn't it be nice to get 56 or 57 out of this and save us? So here's the big thing today. If we get above 56, US dollar skyrockets, and let's just say euro dollar drops. Because then we go back to this whole idea that the Fed raises interest rates, dollar gets strong. Done. If it's probably even comes out as expected, fine. If it comes out like 54 or something, less than 55, I think dollar weakens for a couple of months. Yeah, Ron J says there's rioting in the streets of Venezuela. I know. Yep. Not time to buy yet. That's interesting, Nick. Nick says that his alpha tells him that in September, euro dollar tends to go up. Cool. Has to do with the Fed meeting, though, most likely. Just remember that. So, Nick, go back and see how many times the Fed raised or lowered the interest rates in September, and then overlap that with the correlation at that time with the Fed policy and the US dollar. So anyways, today's going to be a big one, guys. Very important. And then Aussie GDP, obviously a good GDP, lots of good exports, for example, should be favorable for the Aussie. Right? Do you guys know, like, GDP? Right? You got government spending plus business investment plus consumer spending, right? Exports, which is revenue, right? Minus imports, which are expenses. So what I'm talking about is this, if you have good X on your GDP, that should be very favorable for Australia. So you want to kind of look at that. And if it's favorable for the Aussie dollar, then maybe we've bottomed out on those interest rate cuts, right? Easy peasy lemon squeezy. So you can look at the subcomponents of the GDP if you want to be cool. Okay, and then rolling over into the next day, depending on where in the world you live, because in some places that's the same day. Tomorrow at 10, Bank of Canada wants to what? Raise interest rates? Probably not. So either cut interest rates or keep them the same. So this is going to be an important part of your trading week. So what are you going to do? Are you going to scalp it? Look at this, IVPMI coming out the same day. Wow, that's ridiculous. Redonkulous. So what are you going to do? Scalp it, or are you going to front run it? If you're going to front run it, that means you probably should get in your CAD trade today. Aight. So do you think the Canadians are going to raise interest rates? No. If they don't have to cut, excuse me, because they somehow see things getting better, right? Then maybe that's good. So I don't know. So pick a direction. Let's just say Canadian dollar weakness. So what you'd want to do is trade maybe the double bottom on USD CAD on the 15-minute chart at the weekly reversal pivot points, where we're at right now. I don't know. It just seems to me like maybe if you look at the reversal pivot points that we're sitting on right now and then look at the double bottom on the 15, I don't know, that might be me. You say, oh, that could be support. That could be a setup for Canadian dollar weakness. And if that's true, you say, well, I want to front run non-hawkish comments at the Bank of Canada tomorrow. So you long USD CAD or short CAD yen, whatever you want to do, or CAD Swissy, whatever you want to do. And jam your stop at break even. Just say 80% chance I break even on this. But if it's open tomorrow and the news goes my way, I get paid. You know what you call that? Hero or zero? All right, so it's sort of like being like the home run king. You either strike out or you hit it out of the park. Either way, though, you're going to keep your job. So just food for thought, guys. Food for thought. Beige book. That's a nice one. You going to read the beige book? Maybe. Japanese news, great. Chinese news, imports, trade balance, exports, trade balance. You think that would be important? Aussie exports, Aussie imports, Aussie trade balance, same sort of thing, right? You want to see exports up. On both of these, right? That's what you want to see. Exports up. Right? Exports up. It's like a Jay-Z concert. Put your exports in the air. Wave them like you just don't care. Yeah. So anyways, yeah, you want to see the exports up. Come on now. Come on. Thursday. We could deal with U.S. jobless claims, or we could deal with the ECB. Which one should we focus on now? So yeah, so the ECB is going to be a doozy on Thursday. It's going to overwhelm our our day, really, because it's going to mix things up in the European session, obviously. Some people want to get out, some people want to get in. That sounds like a big zero sum to me. And then, boom, something happens. And that'll create volume and volatility throughout the New York session. So it really comes down to what they say, right? More negative on the ECB. So what if they say more an increase in negative interest rates? Gold goes up. Boom! Gold goes up. Whale oil B. What if interest rates stay the same? But it's implied that they're not going to at all do more negative interest rates. Gold goes down, but not much. There's not like a panic to get to the exits, but there's really no reason to add to your gold position. Because we're always interested in the flow, right? Where's the new money coming from? Well, if there's no reason to add to your position, then there's no new money. The trade's already happened. If you buy now, you're just a liquidity event for someone that was smart and bought earlier. Then, they say, hey, we're thinking about getting rid of this whole negative interest rate thing. It's just not working. Boom! Gold just tanks. Just tanks. Down 33 bucks in a day kind of stuff. Okay. So there's your gold play. Gold and ECB. So the the decision at 7:45, the press conference at 8:30. So the interesting thing is, you get the decision, and you get the spike, the pop and stop, and then anything could happen. Excuse me. Anything could happen at the press conference because Draghi may give some sort of forward guidance. And we don't know what that forward guidance is, nor do we know how the market will interpret what that forward guidance was. And I've seen markets completely misinterpret what was said. So that's the fun part, right? And what could happen is he says, negative interest rates are just not working in the Eurozone. So the markets just go crazy. And then 15 minutes later, he says in a Q&A, yeah, but we have no intention of changing anything. Oh, snap! And then it all swings the other way. Seen it all before, my friend. I'd be surprised if I was surprised. Okay. And then, yeah, CPI, PPI out of China. Yeah, could be important. Yo. Okay. Aussie's worried about real estate bubble, but I don't know what they can do about it. European exports could be interesting, right? Anything you can do to make Porsches, Mercedes, BMWs, Ferraris, Maseratis, etc., more affordable, I'm all for it. Bring it on, Bubba. Bring it on, right? Because, first of all, exports will help Europe. But if those exports are going to the United States, that may mean the economy here is doing good, and that's a double win. I casually said to my wife, I'm like, hey, I was thinking about buying a Porsche. And she says, yeah, I think that's a good idea. I almost like drove off the road. Like the SUV almost flipped in the ditch. Like, what the hell did you just say that was a good idea? I'm like, economy doing good. What kind of wife says that? Gee whiz. The last time I did that was one time where we're driving home from a party, and some woman had brought her fresh out of the womb baby. Thing that looked like a maggot, you know. So my wife and I are driving home. She said, "Oh, I just love the smell of babies." No, almost drove off the road. Oh my God, no, no, no more babies, no more babies. She's like, no, 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 that's not what I meant. I'm like, just no more babies. No, no more. No, no. Yeah, yeah. No, that's not what I meant, honey. No, just no more babies. You have a login problem, Smith? What's your login problem? You can't log in, I suppose. Yeah. Really? 3, 4, 5, 6 people can't log in. Well, I did tell the team to find a way to improve the speed of the site. So I guess by locking out all our members, it speeds it up. I'll say, hey, thanks for thinking out of the box, tech team. You're totally right. If we lock out all of our members, the site is so much faster. But could we have a... All right, so I set that info. So you log in through Facebook, and so if you do it that way, not a problem? Oh, all right, well, thank you for the feedback. I already updated the tech team. Okay. So how are you guys feeling emotionally? I know we never really get to talk, you and I, one-on-one. Trading so right? Could be better. Yeah, falling yen tends to do things like that. Yep. Going great. Oh, Michael asked a good question. Would this be a decent day to consider hedging? What did you say? A Kiwi yen. All right, well, let's look at a Kiwi yen. So this idea is, when do you hedge your long-term long? By going short? Hang on. You need to discover the issue and fix it. Gee whiz. Oh, it could be this problem. It could be, I don't care what the problem is. Fix it. Just communicating to the lovely tech team. Okay. Excuse me. So it ultimately comes down to this. Are you worried about this area topping out, obviously, with this area? Well, let's take a look. Are there reasons why? Besides that, let's zoom in. Seems like there might be resistance. Come on, drawing tool. Okay, so we know there's like some sort of price action issue going on here. Fell into support, which is fine, right? So what you have to do is mark this across and mark this across. Okay? Yeah? So predict the future. MR1. Yeah, right? Yeah, MR1. All right. So notice that on this hourly chart, when you're down here, the 55 EMA predicts a double top. Okay. There's more to the world than that, but if you're using moving averages, that you would already have predicted that. That's what it means. See here, you're bullish and aggressive. When you kick off the 21, it assumes a higher high. When you step down to the 55 EMA, okay, it's still a higher low, but it assumes now a double top, not a higher high. So you're bullish and aggressive here, bullish and conservative here. And if this rolls over, it's assuming a lower low or at least a range, depending on how bullish you really are on the longer term, okay? So at the very least, it comes down to this lower yellow area, minimum. But you're definitely vulnerable to making a lower low. So for example, if MR1 is the top, this really could go down to MS1. MS1 is way down there. Just happens to be where I bought. Well, I don't know. I don't know why someone buys at a monthly support pivot, but it turns out that I did. Okay. So should you be worried? Well, I don't see why you wouldn't be worried, but you can also look at higher time frames for guidance. You could say, well, based on this, what will probably happen on the hourly that we just looked at is we kind of range for a while and then we break. Because remember, on the other time frame, we had sort of an upper zone and a lower zone. And if this chart says, okay, the 21 on this time frame is going to take us north, then all we need is sort of like we had a top up here, right? Then we had our double top, then it might just be double bottom and then break up like this on the hour. Okay? And this is an idea where you're looking at the higher time frames first, but they're not lining up, right? So what you do is you look at the medium term and say this will be down for a while and then up into the longer term. And your shorter time frames need to do like up and down and 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 up and down, while this one's going up and down and up. And meanwhile, on the high time frames, it's just up. And that's like juggling 3 balls in the air, right? So, according to this, we have a 5-8 cross up. We have a Stokes cross up. We're above the 21. And it says there's a very reasonable chance this does go higher, right? And right now, the target is 77. You know, we're only at 76, so what's the big deal, right? My target is 79 and change, because 80 just might be a psych level, right? I don't know. Can't predict the future, but 80 might be a psych level, right? Is that a carry trade? I don't know. What does it look like to you, Rick? Or is it, sorry, Nick? So when I took that trade, Nick, somebody asked me what my target was, and I said Thanksgiving. Yeah, could be a rabbit, could be. Yeah, I don't have a price target. See, if you look closely, I cannot lose money. There's a stop on that. I cannot lose money. Every single day I get paid money. I collect interest. And this is paying more than 100% per year interest. And I'm a simple guy. You know, I'm just a simple guy, simple man, and I'm okay with 150% interest per year on my loans when I loan when I loan New Zealand money. I feel comfortable with that. I don't need too much. I don't need too much. I'm a simple guy. So I'll say, yeah, I'll lend you money. You pay me 150% or I'll break your legs, huh? F you, New Zealand, where's my money? That's pretty nice, huh? Well, Miles, let's say New Zealand pays you 1.5%, and your leverage 100 to 1. Yeah, now you make 150%. Boom. And it doesn't always work exactly that way, but I just rough it. It's enough. So if it turns out because of leverage requirements and exchange rate mechanisms and stuff like that, if it comes out to only being 90%, I'm still okay with that. I mean, compared to what you get somewhere else, right? So I just consider this like money sitting in a bank. So, like, for example, I'm thinking about lending Ford Motor Company, and I expressed this earlier, so it's no big secret. I'm thinking about lending Ford to Ford Motor Company. I'm going to lend them money, and I'm going to charge them almost 10%, more than 9, less than 10. That's pretty cool, huh? And then I'm going to take the money, the profit that I make from them, from Ford, and I'm going to buy a Porsche. So I was telling her, that's how you explain it to your wife when you want to buy a Porsche. You're like, no, 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 no. It's free. I'm going to hedge the whole thing, and it's going to be great. I'm going to take all the profit that Ford pays me, and I'm going to buy a Porsche with it. See? See? See, only a poor person would spend money on a car. The worst investment you could possibly make. Right? So think of it. You lend Ford Motor Company $100,000 for 5 years, and they're paying you 10% per year. So at the end of 5 years, you get your $100,000 back. But what's your profit? What did you earn over the 5 years? 50 grand. Boom. Now you can buy yourself a used Porsche. Boom. Free Porsche. What kind of car can you get for 50 grand? Well, you can get a lot of Ford for 50. You can't get a lot of Porsche for 50, but you can get something. You see what I mean? And then you can justify buying it now and saying over the life of the 5 years. Yeah. All right. All right. So there it is. But it's an interesting thought, right? I mean, it's just finance, right? It's essentially what financiers do. That's the how the market works. It's kind of interesting. So like I was saying, a poor person would spend their life savings buying a car that will depreciate. Or a wealthy person would just find a way for someone else to pay for it. They drive the car and it costs them nothing. They maintain their principal. All right. So anyways, kicking off the bottom here. Kick it off the... How's that go? Kick it over here, baby pop. Let all the fly skimmers feel the beat. Right? So kick it over here, baby pop. Kick it off to 21 and take it north. Okay. That's the thought there. Daily says what? What does Daily say to you? What it says to me is when we stretch out and get to our pivot profit zone, it's going to be way overbought, like for a long time, like the duration of overboughtness is going to entice people to get out, take profit, not get out, but essentially the same thing, right? Take profit. There will be a liquidity event sort of in here, in the center of the target. The closer you get to the MR2, the 80, in this case, what is it, 77? The closer you get to the 77, the more the market's going to want to come down. Okay? So, going back to the question, when do you hedge? Well, certainly up in here. Okay? So, I would put that in my notes. 77 would be a good place. Or drop into here and observe it now. And say, okay, if it does this, I'd say game on for the hedge on. Why not exit instead of hedging? Yeah, absolutely valid, fair game, Nick. Absolutely. One of the things we had talked about, however, in past webinars, excuse me, in particular when I took some of these trades, we were talking about if you take the trade in the third week of August, you want to stay in till the end of the year, because as long as you're long, you're going to also get your interest rate payments. Now, right now, that's really not a big deal. Like earning 100% a year is pathetic. Okay? This pair used to pay 850% a year interest. Right? And when it did, John Taylor of FX Concepts, the oldest hedge fund in the foreign exchange market, year after year after year after year after year after year after year, paid himself a salary of $250 million a year. Okay, per year. Salary, not performance bonuses like, oh, we had an amazing year, boom, 250 million. No, salary. He did it year after year after year, according to his IRS taxes. Just year after year after year. The interesting thing about their firm is they didn't even try to make pips. So Nick, when I was discussing this, 6 weeks ago, 12 weeks ago, 24 weeks ago. It was more of an idea of training you for the future and not just like, I mean, just imagine a world where we're all just trying to pick up the next 25 pips and that's it. 25 pips, 25 pips, 25 pips, 25 pips, 25 pips, 25. That's what you're going to do every day. Just try to get the next 25 pips, and that's how you live. What I was trying to teach is that there are other methodologies that really big institutional investors trade. They're not going after 25 pips, right? Because think of it, if you're a scalper or a spot trader where your whole life is either 25 or 30, 40 pips here and there, the only way you're going to make big money is by increasing your lot size. And eventually, that will lead you to failure. So it's like, how do you eventually trade like an institutional investor? And that's where I'm trying to get you, right? So again, think about an institutional firm that was trading Forex for 30 or 40 years, making huge sums of money, and they were not even trying to make pips. Amazing, right? So when we were talking about this, the idea is to get long, and go after the 100% per year interest per year. It's probably actually works out more than that, but let's just take it, right? Because one day we will be in a situation where this will be a big deal again. Okay? And I'd say in the next 5 years, yeah, you know, we might be more at like 250% a year type stuff. Okay? Which is, you know, pretty good, right? So anyway, so being long-term long is good. Now keep in mind, you know, I'm up 300 pips, right? So this trade has paid me $3,000 because you can see it's just one standard lot. All right, this is just the fun play account. So this one's up $3,000, okay, which is all right. Now, if I stayed long for 6 months, so from August to January, right, that's going to be about $500 interest payments on top of that. More or less, could be 400, but whatever. You get the idea, right? Which is pretty good in of itself. Okay? But this may have only taken $1,000 of my equity. You see what I mean? So I'm already up. Well, I can't say that because this is future, right? And of course, some people would have to do the discounted cash flow analysis of future interest payments. But anyways, you know, not even including the interest payments, which you can see as a percentage of the money I've actually used, is actually pretty good. You know, I'm already up 300%. Now, do I want to get out of such a thing that's paying me 100% interest? Paying me 100% interest? Well, maybe not, right? I might want to stay in that as long as I possibly can. I mean, wouldn't it be neat to stay in it for years? So what the discussion was before is you open up a second account. And it's not really hedging. So like Nick says, stupid question, why not just take the profit? Well, how about this? Instead of killing the trade that pays you money every day, because the nice thing about this is like I woke up this morning and I'm already up, you know, a lot in pips because my positions went up in value. And, you know, you might be trying to make 20 or 30 pips today, and I might have already made 300 pips today, and you know, without even doing anything, right? So that there's a virtue in that, right? There's something nice about that, right? So then, looking at this, but what about the days that it does tend to come down? And it will. What do you do? And that's this hedging idea comes out. But it's not a dumb hedge. What you want to do is like an alpha, a dynamic alpha hedge. Tell that to your clients, and they love it. What it means is when you're looking at something that obviously is going to come down for today or in the next few hours, on your other account, right? So just have one that's long-term long only. And then you take the other one that is only short-term short, and you pick up these pips. You take the trade. And it's not really a hedge. The rules of engagement is short-term short only. Okay? Overnight trades, forbidden. No overnight trades, because you don't want to lose the interest payment. Okay? And instead of calling it a hedge, because I don't like it, like maybe Nick feels the same way, like I don't like the idea of hedging because it just feels stupid. It feels like what dumb money does. Right? Just hedge out of because they can't predict the future or something. Just blindly hedge. The way I look at it is this is an income-based trade. Okay? And my long position on this is not an income-based trade, it's a wealth-based trade. Okay? I intend to be in it for a long time and it will appreciate in value. This one is I'm in it just to pick up some pips, right? I'm in it to pick up some money. And if it's obviously going to come down today, but let's say obviously going to go up based on your fundamental analysis, if not today or this week, probably next week or the week before or the week after, right? So you're like, okay, I'm good. You know, you'll be in the position, you'll still collect the interest payments even if the value of that position goes down on the short term. You'll still get your interest payments. All right, so that's fine. You don't have to worry about any of that. But if this is going to fall 100 pips today, or this, if it's going to go from 76 to 75, well, take the trade. Just don't hold it overnight, because if you hold it overnight, you have to pay interest on your position. And that offsets the whole point of you being long-term long. Okay? And if you pick up 100 pips today, on the shorter term trade, it does offset the potential profit you could have saved, right? When you had taken if you had exited your long-term long. Okay? But most likely your long-term long, all else being equal, will continue to be long-term profitable. So you wouldn't want to exit it. Because you sleep better at night if you're up 700 pips. Right? You can sleep well at night. And your positions get bigger and bigger and bigger and bigger and bigger. All right? So the other part of that is, of this, is like, let's go back to the 1 hour. Okay? There certainly could be, another long trade here, another long trade here, another long trade here, another long trade here, right? And you could have them stacked up. Okay? So you want to keep those in as long as possible, because now you're earning, let's say in that case, you're earning 500%. Well, you're earning 100% interest on $500,000. Okay? You're earning 100% interest payments on $500,000 worth of New Zealand dollars, right? 500,000. What am I risking if my stop is at break even on all of these? You see what I mean? Zero. See what I mean? So Shug's first time building a portfolio, you're up now 18,000? Yeah, right on. Yeah, it's the way to do it though, right? Like once you've hit it, you become addicted, right? So Shug knows. And I think Shug is on 3 or 4 of these positions right here on the Kiwi. Oh, now 7. All right, 7. Good job. How far do you place a stop when waiting for a lift off? You know, I manage them as if they're not carry trades. Okay, I manage them as individual trades. Where it becomes a carry trade is when I decide here, and I entered, right, to just simple role reversal. Remember, there's a monthly pivot and all that kind of stuff. So there's pivots in there. And I waited, I think there's a double bottom before this. Like, it's really stupid, easy, boring, dumb trade, right? I think this is the part of a double bottom. And then it came up, and then it came down, right? And then it made a higher high, and then it came down, and I bought it. I mean, just like ridiculously easy, right? With pivots and the psych level here. Like, just dumb, right? Fine. And then it's this point in which I decide. Okay, I intend here, but I still have to enter it just like any other trade, right? Fibonacci retracement, higher high, higher low. And once it does this, I've decided. I move my stop to break even, as you see here. It's 1 pip below my entry. So I'm risking actually 1 pip. And, you know, when price is up here, I move the stop and I'm done. And that's what I said I was going to do, right? I mean, I actually said it weeks and weeks and weeks and weeks earlier that that's what I was going to do. And so that's what I did. And, you know, on this account, that's all we need. I need to show you how to carry it, right? So there we are. And then you move on. Why would I need a bigger stop, Miles? So I trade it just like anything else. So on this hourly chart, once it's made a higher high, okay, imagine this process here. It makes a higher high on this hourly chart, right? And the low is here. What am I going to do? And here's the role reversal, right? But I do this on every trade. Well, I didn't scalp it though either, Miles, right? So, and you know, you and I probably scalp differently as well, but the trade is like any sort of, let's say, spot trade. Okay, I can't go that far back. All right, so it's like any other sort of spot trade, right? We're up here. There's the likely entry, and the stop would just be somewhere below this, right? Right. And the risk is a whopping zippity doodah, right? But of course, there's patterns in front of this, like, you know, this low is lower than this low, and so this low, right? Or should I say, this low is higher than the previous low, so this low should be higher than the previous low. And keep in mind, I also have fundamentals behind this and seasonality. I mean, all the things that we could talk about it weeks in advance. Therefore, it's a lot easier to believe if you already have a trade plan, right? So I already had it planned out. So once it made a higher high, I'm waiting for a higher low, and I get a 50% retracement back to a psych level of 73.00 on a pivot, on a monthly pivot. Like, it's so straightforward, boring that, you know, of course you take the shot. And you're like, yeah, okay, if all of that collapses, well, you know, I'll lose that, whatever it is. Whatever, I don't know what it was, 50 pips maybe, I don't know. Doesn't matter to me. Right? And then off we go, as it was supposed to, right? Now, yes, we are vulnerable to something like this. And yes, now you could possibly hedge it or higher up, even more likely. Okay? And that's why I say you should have a different account just to mentally stay with your strategy. Okay? Okay? Okay. So like if you saw this as vulnerability to your position, then I think you should do something. Isn't that what your job is as a manager? If you see risk increasing to your position, you do something. But if you see this vulnerability, then you know in the short term there's an opportunity. And the cool thing is once you start to understand this, you understand what other people are likely to do before they do it. Because you can break the whole market down to there's lots of people that are worried about risk to their positions they're in now, and a whole bunch of people that see opportunities to take risk because they're not in the market. So someone's going to say, oh, this is definitely going to be a top. So they're going to trade it. That's their strategy, right? Cool, right? So over time, you'll get better at saying, oh, well, someone's going to take that on the short term, so I'll go with them. And you're not necessarily doing it to hedge your position. You're doing it because you're obviously going to make money. Okay. If you're a bull, 3A2, 50%, 618. So if you're a bull on this 5-minute chart, your plan today is probably something like that. Those types of trades are difficult after long weekends, though, just because everything gets messed up. Do you earn more interest when you're leveraged? Well, you earn interest based on the size of your position. Now, how much based on your leverage? Well, there gets to be a limit to this, and this is where you need to talk to your broker and look at your agreements and stuff that you sign with them. Because let's say you don't have a lot of money, so you jack up your leverage. You're like, give me 500 to 1 leverage. Well, one of the things that very often happens is you don't get the full interest or any interest, or sometimes you pay negative interest on both sides of your trade, whether you're long or short, depending on the terms of agreement. And usually, the smaller your account, the less of a deal you get because the broker needs to make money. There's a lot of expenses running a brokerage firm, especially if you want one that actually gives you good customer service, right? Right? So, a broker needs to make money. There's bills that need to get paid. So one way to do it is, those types of things. When you're a smaller account, maybe you don't make any interest. Maybe you always pay interest no matter what side you're on, or this, that, and the other thing. When you have more money, you can always negotiate a better deal with your broker. And institutional accounts make way better, swap payments or interest payments or whatever you want to call it. They get much better terms because volumes are higher and leverage is typically lower. Right. Richard says you only make money when you trade. Right. But, when you have a guy that's trading 10 cents at a time, right? And then wants to spend 45 minutes on the phone with support team to set up, his MACD properly. Well, the guy's got to make 258 million trades for the broker now to break even. You see what I mean? So so the bigger you are, the better deal you're going to get. That's in any industry that I know of, right? Richard says, well, if they hold a position for several days, they won't be making much money. Well, like a broker like TradersWay enters it into the interbanking system, so they're done. So remember that Swiss National Bank debacle? And Alpari went out of business, and FXCM had to get an emergency bailout. They had to beg for money from horrible, horrible terms just to stay alive because of what happened to the Swiss National Bank. So basically, the largest retail broker in the world, essentially went bankrupt overnight because of the Swiss National Bank. Nothing happened at TradersWay. Totally fine. Absolutely, totally fine. Why? Well, because the trades were already in the interbanking system. Right? Now you might have lost money on your position, but your broker, TradersWay, didn't face a risk where all of a sudden they could have gone broke and now all your accounts are super negative and all that kind of. No, it's just because they weren't holding your position. It was in the interbank system. So, you see what I mean? So that's just one way, like comparing brokers, right? I'm like, don't even take my opinion for it. I'm not even giving you an opinion. Just look at what happened in the. Some brokers went out of business. Some nearly went out of business, and some were not affected at all. See what I mean? And then you decide what you want. Hey, did you know Brazil's going to plant the same amount of soybeans in the next year? Just want you to know. I don't know if you're trading soybeans. When you walk onto the trading floor at Chicago, the first pit you walk into is soybean meal. I'm like, oh my God, I'm in the soybean meal pit. This is awesome. Would anyone else dig that? Or am I the only one that would get super excited to be in the soybean meal trading pit? So that's me at the S&P 500. Okay, just quick updates here. Oil. Zoop, 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 doop, zoop, doop, doop, doop. So how about Putin, huh? Isn't Putin doing an amazing job? He got to keep Ukraine. He's building Air Force bases in Syria, right next to Israel, in the Middle East, which he didn't have access to before. He's buddy-buddy again with Turkey. And now he's buddy-buddy with Saudi Arabia. Holy smokes, has the U.S. screwed up their Middle Eastern policy of the last 40 or 50 years, huh? Wow, it's just like shocking. And then you got Putin in there, and he's just like scooping it all up. Just an absolutely amazing job on his part. There's one guy with a strategy and a whole bunch of other people running around like chickens with their heads cut off. Just amazing. So anyways, Putin's in there hanging out with the Saudis, best friends, working together. That's why you see this big move here. This is Putin. Amazing, huh? So oil originally pops up, and then people realize, it ain't going to happen. But now that Saudi Arabia and Russia are pumping oil at 100%, as well as everybody else, they've agreed to not pump anymore. So funny, huh? And I think, the initial move is just people reacting, potentially dumb money, I guess. I don't know. But you realize when some of the biggest oil producers in the world agree to halt production at full capacity, that it's pointless to even have the agreement because they can't produce anymore, even if they wanted to. So to say, whoa, 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 I am going to agree with you to only produce at 100% and not produce more than 100% of my capacity. You're like, well, what kind of deal is that? Right? Yeah, Joseph says, and the market wakes up and they realize nothing's been achieved. Also, wouldn't it be interesting if Russia and Saudi Arabia actually were the ones that did that? Popped it to get the suckers in, right? So hedge funds used to do that in the stock market. It's called pump and dump, which is completely legal. What's illegal is sort of the Wall Street movie version, where you call the Wall Street Journal and they start printing fake information. That would be illegal. Or gathering inside information and trading that. That is also illegal. The pump and dump is completely legal. You guys know what the pump and dump is? Well, it's more than buy and then sell. Let's say you needed to sell on the first Monday of the month. Physical oil. The first Monday of the month was yesterday, right? You needed to sell a lot of oil. Physical oil. You have a ship coming to port, and you're going to unload it at the refinery, right? Okay, you got that? That's cash. Okay. So what you do is you go into the futures market that's leveraged, what? 40 to 1. So you use this leverage and you take what? You're going to take 30, 40 million, leverage it 40 to 1, and buy, in particular at the market open. And you create in the futures market this giant spike. And the idea is that all the other dumb money see the spike and they start buying too in anticipation of it going higher and higher and higher and higher. And so you actually created the market going up. So you're actually now profitable in the futures market because you're buying. And now as other people buy, you can scale out of the futures position and make money. But what else are you doing? You are selling your physical oil, not at 44, but at 47. Now, do you think the $3 makes a significant difference if you have a ship coming to port? Okay, so let's look at an oil tanker. Oil tanker sizes range from general purpose to ultra large. But it's not in barrels, is it? So a long range, 80 to 160 deadweight tons. That's not a very big one. So APG, general purpose, we don't want that. Long range, so what am I doing? I'm doing a long range to, okay, long range to, I'm actually looking this up, guys, sorry, hang on. Long range, between 300 and, all right, so it's 500,000 barrels, approximately. That's a very random number, because you can get much bigger than that. Okay, oops. Right? 500,000 barrels times $3, huh? Joseph says 2 million. Well, then I'm going off of a really small ship. So let's just say, how about 1.25 million, right? Joseph is saying 2. I said 500,000. So let's say 250,000 barrels, according to Joseph, would be medium, right? Right, but that was a large one. I wasn't picking the largest. All right, so let's say that's truly medium times $3 a barrel, right? So you're looking at, like, if you can move the market even for a day, right? It could be for every $1 you move the market, you make an extra $1 million. Okay? But per ship. Now, whether you unload today or tomorrow doesn't change a damn thing, right? The only thing that matters is the price in which you unload this cargo. And what if you have multiple ships, right? Well, and Austin says, and what if you made money in the futures market? Yeah, and you probably did. Or at the very least, what you're trying to do is jam this up so all of a sudden the volume and volatility in the oil market at the open skyrockets, right? And there's probably not a coincidence, guys, that you know, the deal with the Russians and the Saudis occurred on this particular day. I mean, none of it's a coincidence, right? But anyway, so this all of a sudden you see the pit just light up and huge orders coming in, right? And it creates a feeding frenzy. It's like throwing chum to the sharks, right? And they're just unbelievably excited. And if you started, you know, buying down here, you're going to hopefully start selling up here and get out of those positions, so that you bought in the futures market and then exit it at the bare minimum, you didn't lose any money. But you might have made a couple of $1,000,000 there. But the bigger thing is you're dumping physical oil today. Okay? You're dumping the physical oil and making $3 million extra for doing nothing except manipulating the market for a few hours. But now, what if you're a hedge fund and you want to unload a bunch of Bank of America stock, but you own like 3 million shares, and you're worried about the market coming down because you're at a top. Imagine the S&P 500 now is like at a double top. How do you exit your trades without actually creating the lower low? Once again, you go to the futures market, and at the open, you drive it up into a higher high. You know, in your hedge fund, right? You have $3, $4, $5 billion. So what kind of impact can, $100 million leverage 40 to 1? What kind of leverage could, or 100 million times 40? You throw that at the S&P 500 at the open. Can you move the market for a little while? Can you create a feeding frenzy? And all of a sudden, all the dumb money sees green candles, right? By the way, have you ever noticed that the London market opens that way? You get a big move one way, and then you start buying, and then the whole thing collapses and reverses. Wonder what that's all about. So anyway, a hedge fund could go into the futures market, drive up the S&P 500 futures or individual stocks and stuff like that. But let's just say creates a bullish day for the S&P 500. The index skyrockets, maybe even makes a higher high. And Bank of America stock starts going up, 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 which means people are buying it. And the hedge fund is doing what? Selling Bank of America stocks as fast as they possibly can. And everyone else is like, the S&P 500 is going up. The S&P 500 is going up. Give me Bank of America stocks. Give me Bank of America stocks. And you're selling them. Boom. All right, 15, 15, 10, 15, 20, 15, 30. You got more. Here you go, 15, 30, 50. And all of a sudden, you're running out of buyers, right? And all of a sudden, it's up to almost 16. And then you're selling at 1580, 1570, and you're selling more and more. This guy will take 10,000 at 1560. You're like, all right. And all of a sudden, it starts coming back down and back to 15 and back to 14. But you're just unloading. So you unload it on the way up, and then you unload it on the way down, and then you stop when it looks like it's collapsing again. And you're done. And maybe you don't fill your full order, your full block. You wanted to dump 2 million shares. Maybe only sell 800,000 of your shares. But you sold it in an upward moving market. And then once you filled all those orders and there was no one else that wanted to buy it at 16, you just stop selling when it hits 14 something, and you're like, well, on average, we unloaded 800,000 shares at somewhere between 15 and 16, and you were happy with that. Now, if you had gone into the market open as a seller alone, and you just the stock would have gone from 14 to 13 to 12, because you're selling, and there's just not enough buyers, and all they see is like all these big sell orders coming in. And no one wants to buy in a falling market, right? So they just step aside. Maybe they start selling and they drive the price down, and you've just hurt yourself as a hedge fund. You see that? You got 2 million shares. You can't watch the stock drop $3 because there's only people selling. So what you need to do first is create a lot of buyers and get the market to want to buy 800,000 or 1 million or maybe even 2 million of your shares. So you have to create the buyers first. Because if you just go in as a seller, then you've created a seller's market or a selling market. You see what I mean? Kind of interesting, right? When you got bigger money. So lots of food for thought today. I hope I didn't diverge too much. So I taught you how to buy a Porsche for free. Taught you how to make $250 million a year, earning no pips at all and holding no risk. We talked about hedging a long-term position based on wealth by income trades on the short term. And we went through the calendar for the week to look at risk events and opportunities like front-running the Canadian dollar, which, by the way, has weakened. That's been a pretty good couple of hours, right? I feel like it was a good thing I rolled out of bed today. I hope you feel like it was a good use of a couple of hours of your life. Well, then that's good. Then we're a team. I will be here tomorrow. Will you join me? Great. Wonderful. So what I'll do then is I will download this video, upload it to YouTube, and then pop it on Forex.Today. I hope you leave a like and a comment and all those things. Can I post Thursday's video, please? Yeah, we'll see. Yeah, maybe. I'll see what we can do. I'll try. It's just it takes a long time, and I have to write a paper today. I know. So peace on earth. May the pips be with you. May your profits be above average. I'll see you tomorrow. Miss you already.